Thank you for joining us for another episode of Junior Mining Talks. Today with Michael Gentile, who we spoke to over half a year ago, but not all has been right with the world since then. At least not the junior mining world, which is actually where I want to kick it off, as always, on a bit of a positive note. But of course, not before I've warned everyone listening that although none of the companies mentioned or featured in this publication have paid us to talk about them, this channel earns its money by charging junior mining companies for interviews. This means that there is a high probability that some or all of the companies that we will cover in here have paid us in the past or might pay us in the future to conduct such an interview. In addition, all of us are active junior mining speculators, which means we may own shares of companies mentioned in here, or we may have owned shares of them in the past, or we may own them in the future. Please read the disclaimers on your screen right now. And if you're new to this space, please go to the last portion of this video and listen to that warning first, because your capital is at risk. This is a very, very risky sector. But that all said, not all has been right. As I was saying earlier, not all has been right with the world, and definitely not the junior mining world. So how do you deal with that, Mike? I mean, like your biggest holdings are worth millions of dollars, on occasions almost double-digit millions. So large positions in absolute sums. How do you deal with it when you're down on a position that big, and maybe it doesn't make too much sense to be down on it, or at least not in your head? What's happening inside your head? How do you deal with that?
Yeah, it's a great question, and everybody deals with it differently. I think emotions, as you know, drives like 95% of the market activity in the short term, anyway. My one of my first mentors in the business gave me some great advice, which is you always have to have a thesis. A lot of investors, the extent of their thesis is I buy something because it's going up, and I think it's going to keep going up, and that's as far as their analysis goes. And so, for when it stops going up or doesn't go up, they sell out of frustration and make uninformed, poor decisions based on price action and not fundamentals. So, I think we talked a bit about this in our last interview, but I think it's really worthwhile reiterating it. Before I make an investment in the commodity space, you got to check your thesis. So, what is the backdrop outlook for the commodity that you're investing in? And I said from 2018, which I really went pretty much all in on gold and the resource sector. My thesis has continued to unfold fabulously well. In many ways, better than I hoped for in 2018 when I made that massive bet. I mean, gold's gone from 1,300 to 2,800 US today. A lot of the macro things identified back then are stronger than they were back then, and more powerful. So I think your fundamental backdrop for the commodity has been and remains very constructive. So that's good. So my thesis is not broken. So my outlook for the commodity was good. It remains good. It's performed even better than I thought. So that box is checked. Second box would be, okay, well, how do I want to deploy capital? Where am I seeing the best value? And right now, we can talk about it, but I think it's pretty hard to dispute. The best value you're seeing is from, I'd say, development stage assets and down, and with particular extreme value in the junior resource kind of micro cap exploration, early resource stage companies. And so that's a pocket of value that is just dramatic. We talk about the valuation and why and what's going on, but very extreme valuation opportunity there. And then you go one step lower. Okay, so if I identify the macro being gold, I like that thesis. I see huge value in a certain subsector of the market. If I want to focus my energy and time, then individual companies, I then would say, okay, what companies do I want to invest in? And I've talked about in the junior resource space, high risk, high reward investments. You can't have just one investment. I've talked about my venture capital type model where I own 20 to 30 companies, knowing full well that only 5 out of 6 of those are really going to pay the rent and generate astronomically high returns, hopefully. And a lot of them will not work out, but the ones that go up 20, 30, 40 times your money will do will do really, really well and make you generate a fantastic return if you're disciplined and you stick to your process. So then one last stage would be, okay, of those, how do you pick those 25 companies and when do you decide when to buy or sell? Each company I get involved in, I have a thesis. So like I had a thesis on gold. It's articulate. It's got 5 or 6 reasons as to why gold's going to go up. Every junior mining company I have a game plan, and here's why I'm investing. Here's what I expect to happen. Here are the steps of value creation that I hope to see happen. And here's how the stock should trade, or here's how the value should grow as the company executes on its plan. If the company executes well, keeps drilling good holes, keeps growing the size of the resource, puts out positive economic study, well funds itself over time, minimizes dilution, then the stock price itself, I have a view that company XYZ is going from a $5 million market cap to a $500 billion market cap on full realization of value. if they're doing all the things that I thought they would do to create that value, yet the market still has it as a $10 million market cap because the market is dysfunctional right now, I'm either buying more or I'm sleeping very soundly at night, knowing that I've got values accreting to me, just the stock market's not reflecting it.
Hmm.
If the company doesn't do what it said it's going to do, doesn't have the exploration success that I hope, the economics of the study don't work out, the company poorly finances itself or runs out of money or bad management decision cause it to fall off go in the ditch, let's say, then it's a sell candidate or one that where I would be less enthusiastic to add or to grow my position. So Warren Buffett once said you got to invest in the market like the market's closed for 3 years and you don't have any concern. Now in the junior mining space, you've got to fund these companies, so you kind of need the market to be open or very wealthy private individuals to fund the companies. But I try to shut off the market as much as I can and focus on the value. And so in my mind, the value of my portfolio of junior mining equities has never been higher, and it's logical because the gold price has never been higher, right? So the current market price of my companies is disappointing and frustrating. But if you focus on what you can control and you focus on a process, you tend to stay calmer and hold your wits better. If you focus on price action, and I get lots of emails and texts and phone calls from retail investors that are focused on price action, it can be a very arduous and painful mental process to stay invested and worse for some people, and they lose lots of money or their physical mental health takes a toll. So you've got to really be methodical, systematic, know what you're playing for. And if you get information that proves your thesis wrong, not be afraid to sell or to change directions. But right now, there's nothing in that I see in the near future that is derailing my thesis. And in fact, I've never been more positive on the value that's going to accrue to us three crazy guys here on the phone that are focused in this space, because there's just a tremendous opportunity, tremendous unrealized value in the sector that I see today.
Okay, well, thank you, Michael. This is a great conversation. I'm gonna go restructure my portfolio right now. But
Going to sell
oh,
your AI stocks?
exactly. Luke, I think you wanted to jump in actually with a question there before I move on.
Yeah. In the beginning, you said you think the value is in development and down. So companies perhaps with a resource or less than a resource. What would you define as value? Because when I look at the companies you own, a company like Radisson has gold in the ground, high grade, good area. So I can see where you come from. I mean, if you have a good team and you can come to the conclusion that that deposit will go in production at some point, maybe by one of the majors or something. I can see where the value is. But you also have companies that are earlier stage and they have a thesis, they have a target. Do you consider that
Yeah.
value or do you consider that speculation on a
That's
drill
yeah,
hole?
great question. Yeah, great question. I would say if you don't have access to my full portfolio holdings in terms of dollars, but I would say the vast majority, because we're in a still I'd say a bear market for junior resource stocks, I have very little of my money invested in pure greenfield exploration stories. Not because I don't like them, Luke, but if I get a phone call saying, "Hey, invest in Exploreco XYZ," we have this beautiful land package. We're going to drill a discovery hole. We're going to make everybody rich. What's the market cap? Okay, I want a $15 million valuation for that. Because the market is so depressed, I can get a name like Big Ridge in Newfoundland that's got 1.5 million ounces at a $20 million Canadian market cap that I think has really impressive exploration upside in that story. Why would I pay 15 million for a grassroots, haven't found anything yet discovery story when I can get, a Big Ridge or a Radisson or other stories that have de-risked the project, still selling at, exploration company valuations, pre-discovery valuations because the market's so depressed. So I think we talked before in the past, Luke, it's why I love investing in bear markets when my macro thesis is very positive, because you get to buy things at, multiple turn discounts to what you normally would in a normally functioning market, removing a lot of the expiration risk or the binary risk in the portfolio. So you've taken that risk off. So yeah, my portfolio would probably be skewed 95% of my dollar value in things that are already made a discovery, that are expanding their resource or on their way to a PEA or resource development. And 5%, I might put 0.5% or 1% of my portfolio in a really compelling, grassroots discovery target, knowing full well that they're more binary, right? So, but in a bullish market, Luke, you might have to pay a $400 million market cap for Big Ridge is 1.5 million ounces instead of 20 today. So that's when you go, okay, well, maybe I can pay $5 or $10 million for a grassroots discovery. Because if they make a discovery, their market cap potential is hundreds of millions. Since we're in a very depressed market right now, I can get much higher quality, more advanced projects at really low valuations, which means life for greenfield explorers is probably the hardest place to be right now. Because you go, what do I want to be when I grow up? Well, if you find 1.5 million ounces, you might trade at $10 an ounce Canadian in the ground. Well, that's not a great place. That's why comp sheets matter. It's why the seniors get Nico Eagle making a new all-time high yesterday is a very good thing because the market caps of the big guys trickle down. And so what does success look like? If I'm going to be a producer, I'm going to be a premier development asset, where am I trading? That's the value step so you have to take. And so the bigger the market caps of the producers and developers trade at, the more market cap room there is for the juniors to get better valuations. It's an ecosystem, and that's very positive to see some of the larger producing companies starting to make new highs. That gives us more market cap room for the juniors to grow in value as well.
Is it a benefit for you to be I mean, in the smaller companies, maybe the 20, $30 million companies and below, to be an insider or be a strategic investor where you have a level of influence? Or do you see it as a risk or a downside that you are, that you own a stock that you cannot really trade out of without people noticing? So do you see it as a benefit or a more of a problem?
That's another great question. I would say because my business model, Luke, is a private equity venture capital model, when I make an investment, my forecasted holding period is kind of 3 to 10 years, and both the cycle and the capital availability to move these projects forward will have a big factor on how long that holding period is. So for me, because my model is I'm looking to make 30 to 50 times my money, I'm looking to make that money on an exit, a liquidity event, M&A, acquisition, development, becomes a big board listed stock, whatever that may be. I'm less worried about, I don't trade my names. I'm not looking trying to get in and out. And yes, the trade-off to that, because I cannot, get in and out of the names, it's more of like a private equity style investment. The reason why I do that is yes, I do get to have my hand on the steering wheel a little bit more. When you're making investments of that size, you want to make sure the companies are making good decisions. I'm not saying I have all the answers and I walk on water, but I think having 15, 20% shareholder in company does focus the mind much more on shareholder returns, when to finance, how to finance, who to finance with, what to do in a downturn. We could talk about that, what I've been advising my companies to do in the downturn, right? And what's value accretive and what's not for shareholders. So yeah, so I trade off liquidity and time horizon for influence, and I think better returns over time as these companies have made better decisions, I think, on their share structures and how to create value for shareholders. So yeah, for me, I don't trade my names. I'm not looking to trade off a drill result or clip warrants. To me, it's I'm putting in X today and I want to have 30X in 5 to 10 years. So whatever I can do to increase the value of the company, thinking like an owner, thinking like a private company would, that's how I approach my portfolio.
Listening to Luke's questions here, it seems like I might have to look for a different job soon because he's doing a much better job than I am. So I'm thinking though, how do you? A lot of the times when you look at it from the retail perspective, what I see online is people saying, "Yeah, my company's got good value," and the way you determine value, but the market is just not recognizing it because it's a bad market or because Fartcoin is stealing my company's thunder or whatever it might be. So how do you know that it's the market and not your specific company? Like, how do you know that you're not misjudging for value what is just not value, I guess?
Yeah, one of my good friends, 30 years in the business, once said, "Everybody's a value investor." Right? Nobody buys a stock because they think it's bad value, right? You can buy the most expensive stock in the market on a valuation basis and still call yourself a value investor because you think it's going to grow really fast and grow into its valuation. So value is in the eye of the beholder. Again, coming back to my view, if I am starting off life by saying I'm only going to make money if this is an asset that would be worthy of being acquired by a major mining company, then it's a different lens, right? In the sense that I'm looking for projects that have the potential to be economic ore bodies or mines one day. And that's very hard to find because mines are rare. That's if they weren't rare, they wouldn't be valuable. So my lens is a little different. It's not, hey, I have 1 million ounces, I'm trading at $5 an ounce, I'm cheap. If my view is that those 1 million ounces have no chance in hell of ever becoming a mine, that stock's expensive because basically it's worth zero, right? To me, the way I work is no one's going to buy it. It's either in a region where you can't develop resources due to social or political issues. It's either got a major environmental issue, it's got a grade issue, it's got whatever issue it might be, infrastructure lacking. So those to me are worth nothing, regardless of what the market cap is. So that's my come back to my thesis. If it doesn't have a shot to be a mine, and I take big positions and hold them for long periods of times, and I believe when I started it could be a mine, and now for whatever reason I don't think it's gonna be mine, I'm a seller or I'm not adding to that position. I'm not interested in those stocks. So value to me is, can this be an economic deposit, yes or no? And if it is, and it's trading at a deeply discounted valuation, I'm buying more and sleeping well at night. If it's not, then I'm probably either writing it off in my mind or no longer writing checks or looking for an exit in that stock because it's no longer has any value. So the market cap is to me, the market cap is a dictator of how much money I'm going to make if I'm right. Because all those things can be true, but if it has an $800 million market cap today, and I think the full value of the deposit on a development scenario is 1.2 billion, that's only 50% upside. I'm not interested because I'm looking for multiples of my money. That's why I'm focused on smaller companies that are mispriced that have potential to have that kind of return. So I'm thinking more like a corporate would. I've had a lot of meetings with corporates. Even this week, I've been Toronto meetings with corporates, and that's how they think. They're like, I don't, whether your stock's trading at 20 million or 300 million, they do their own work. They assess what the value of that project is on a fully developed basis, and they're ready to pay a fair price. Obviously, the cheaper the better, but they're looking at from not from the stock market. So what is this project worth as mining company XYZ in a development scenario? And that's how I try to train my mind to work. It's harder because you're earlier stage. There's so many things that can go wrong, or so many unknowns. But as you de-risk these projects, the metallurgy, the infrastructure, the grade, the tonnage, the geology, right? That's how value accretes. And those are my signposts for value creation, not how's the market treating my stock today.
Are you avoiding companies that can kill a story almost with one drill hole? Because there are companies, and some of them I actually like, that have a pretty good thesis or target. They
Yeah.
raise money for that target, but it's really, I mean, within one drill program, you could almost kill it by just drilling 6, 7 holes, and if nothing hits, it's like a done deal. And some companies only have one of those targets, maybe two. And those companies, the share price is completely determined by the result of those drill holes. Do you enter those things, or would you say like, I like this target, but you need to have a little bit more than just this project because the complete company will be a zero the moment you're not going to find it? Or would you still play something like this at say 20 cents or 10 cents, knowing that it will be a 1 or 2 cent stock if they do not hit anything?
Yeah. Yeah. I would say it's a probability based analysis. It's the speculation what you're talking about, which I mean, in the junior space, most stock is speculation because there's so many things that can go wrong along the way. But I would say, what's the price of the lottery ticket? It's really the lottery ticket you're buying, right? So you say, okay, if the market cap in that situation, Luke, in this market where valuations are so depressed, I wouldn't say no to a binary situation, but what's the market cap? Is it $2 million and I'm coming in for 200,000 and I'm getting 10% of the company? And I know if they hit the value of a public shell is 1.5 million, right? Like a listing on the market is worth 1.5 million. So my downside is 500,000, a market cap decrease. That would be something I'd look at. If you're coming to the compelling target and it's a binary event and it's a $50 million market cap, and if I'm right, I make 500 million, and I'm wrong, I'm going as $2 million market cap. That's, what, 90, 95, 98% downside. So I've got to really think that that target's got a really high chance of making a discovery. So for me, I'm happy to speculate. How my mind works is all about I'm allocating capital. What's the probability based analysis of success? What am I paying for that lottery ticket? And if I'm right, what's my payout? If I'm wrong, what's my downside? And it's like I said, in this market, because discoveries or resources are trading so cheap on the ground, the upside is less limited for a discovery. It has to be something like Snowline or like Founders Metals. It's really spectacular that the market's willing to pay for. So that puts more pressure on that speculative bucket of my capital. It's got to be a really compelling risk reward. I'm not willing to pay a big price for a lottery ticket in a market where people aren't paying good prices for discoveries in general or resources in general. But in a different market, like I said before, where resource companies are getting big valuations for existing discoveries in the ground, then the price of lottery ticket might be able to go a little higher because the payout will be better. So it's, if you play cards or poker, whatever, like you're just assessing probabilities. You're doing more work than someone else. You have a better technical team assessment. I'm not a geologist, so I rely heavily on people that I trust to help me understand the risk rewards of certain opportunities. What I bring is, okay, if I'm right, what's the market going to pay for me? Pay it for me. Or a lot of people don't understand that right now. Is understanding the whole ecosystem from Agnico Eagle all the way down to the binary grassroots junior Explorco. You have to understand what does success look like in this market environment. Don't overpay for the probability of you being right. The worst thing to do is you're right and you don't get paid. You paid 30 million for the lottery ticket. They made the discovery of, wow, now you're trading at $35 million market cap because the comparables are trading there. You have to understand ahead of time what kind of reward you're going to have. And there's guys who do it better than me, like pure grassroots exploration. Yeah, if I'm a PhD geologist with a track record of massive commercial discovery, maybe I'm willing to pay a bit more for that lottery ticket because I really have more confidence in my odds. But the market is so good right now, good. It's so bad that it's so attractive. These risk rewards are just attractive in general across the board. And then by doing extra work, you're getting, I think extremely positive risk reward opportunities in this market.
I like that example. Kind of sounds like my strategy: all risk, no reward. How much patience is too much patience, though, Michael? I mean, when you buy something like that, you say you're buying some of these stocks, you're buying them with a 3 to 10 year holding period. But how much patience is too much patience? I mean, at a certain point, a lot of these companies just get mismanaged. Someone promises you something, you believe them, you like
Yeah.
them, and stuff like that. When do you stop being patient? When are you like, this is enough?
So one, the geology is broken. So if we could talk about management is very important. Management will dictate the pace and the value which is creates to shareholders. So good management can take a good project and make it amazing, or a great project and make it fantastic, or bad management can take a great project and make it difficult, right? But for me, it's really the geology. Is there anything along the way that has told me this has no chance of being a mine? We talked about that. That's out. Um, but I'll give you an example. Radisson, when I got involved, I've probably been involved for 5 years, got really involved kind of 2, 3 years ago. When I first got involved, it had 450,000 ounces of high grade. And so the knock on the project was 450,000 ounces is not big enough. You need scale. You need to have at least 1 million ounces, which is 100,000 ounces a year for 10 years for the market to care. And they went out, limited capital, drilled the resource, got to 1 million ounces. Big de-risking point. 1 million ounces, 10 grams. Now you got grade, you got scale, you got infrastructure. The next knock was metallurgy. How are you gonna produce it? Can you get the ore to the ground and have the recoveries you need to produce that? Well, that's in process right now, being de-risked. Another issue was how are you going to build the mill? What are you going to do? Well, they signed an MOU with Ion Gold to talk about potentially using their Doyon mill for processing Radisson ore. So step by step, the company has been de-risking the process. 6 months ago, I think we've talked to you, brought in Matt Manson, who's got experience in building multiple mines. We had a Peter McPhail, who's the CEO of Alamos, Pierre Baudouin, who's built multiple mines, very successful mine builders, to our team. What that did, Antonio, was we were de-risking the project, but bringing in those really experienced mine builders have accelerated or compressed the timeline it takes to get through these value creation steps, right? So if you had just me and you running the company, Tony, we probably could have done a lot of those steps. We'd have done them a lot more slowly, probably with a much higher cost of capital, with a bunch more mistakes. But the geology is there that I think Radisson's deposits 2 to 3 million ounces of really high grade. I know the infrastructure is in place. That ore deserves to be put in the mill, but good management can make that happen in 2 years. If you and I are running, it might take us 10 years. So but you can't change geology, you can't change infrastructure, you can't change the location of that project. I believe in that investment from 4 or 5 years ago that those ounces were going to be cash flowing ounces. But now that we've de-risked a lot of the steps, now we have 3 proven mine builders on our team. Things are moving very, very quickly there. So that's how management can accelerate. But if we didn't have the grade, the metallurgy sucked, we didn't have the scale, then no matter what management team you have in there, they can't make miracles. You can't change geology, you can't change the structural nature of the project. So I would have concluded you could bring in Sean Boyd to run a company that has a flawed deposit, and he cannot make that a mine, no matter how good he is. He can't make it a mine. So you have to have a combination of both. And so my patience, if I don't like management, but I love the project, change management. And that comes back to Luke's point. If you own 10, 15, 20% of the company, you have not a guaranteed ability to change management, but you have a much stronger ability than if you own 10,000 shares and you're stuck with the team that you have. So you can change management, you can't change the geology. You can make things move faster or slower based on decisions that you make. So my patience would run thin more on project geology or structural issues than it would with bad management. But I don't want to have too many problem children in my family. You can't deal with too many, difficult management teams at the same time without burning out. So maybe if you have too many problem children, you focus on the one with the most potential, right? To get them tutoring or help them get through school, but you can't do them all, right? I mean, it's sort of how I look at my portfolio. So ideally, I want to have good management at the get-go, but it's not a showstopper for me as long as they're not entrenched or I feel there's a path forward to improve things.
What type of CEO is a no-go? I mean, can you describe, without necessarily mentioning names, things that you have seen and you thought, well, I like the project or I like this company, but this CEO is a no-go? I mean, can you describe something like that?
Yeah, and do
Yeah, I would
mention
say in general. Sorry,
do
did I cut
mention
you?
names. You're free to mention any names.
You guys have seen a lot, right? I think a CEO that runs the company for him or her at the detriment of shareholders, where it's very clear in the first meeting that this company, what may have a decent project, is run for the benefit of the CEO or maybe the board members. You see all kinds of bad stuff in this business, Luke. You see a company with a $5 million market cap that vends in a project that's worth nothing for 5 million of stock. And then all of a sudden, management owns 50% of the company, but they put no equity in. They put a bunch of moose pasture in the company. A company that I come in and see that they're trying to finance a deal at 25 cents, and I find out that out of 80 million shares outstanding, 70 million shares were issued at a penny. And so it's all cheap stock issued to the founders and insiders. And so they're asking me to come in at 25 cents. And surprise, surprise, for the next 3 years, the stock is for sale at any price above a penny for the next 3 years because everyone's in on a profit. So when you see stuff like that, regardless of the project quality, I know it's going to be a heavy lift because you're battling, versus a company that involved in like Capitan Mining. They're just marketing in Montreal with me this past week at a lunch with investors, and there's no founder's paper. There's never a single share issued below, and all the management shares were bought in private placements alongside investors. No warrants currently outstanding in the company until the recent financing they did, but it's a very accretive financing. There's no insiders own 35% of the company, right? So there you can't guarantee the geology is going to work, but at least they're doing things in the right way, and they are a partner at the table. I own 16%. One of the founders owns 8, management owns another 5 or 6. So we're all in this together, and we all paid the same price for our shares, right? So that aligns you. So I don't like some of the financial engineering that goes on. It just sends a signal to investors that there's two classes of beneficiaries. There's the public shareholders and there's management. I don't mind management having some equity. Some options are fine. Fine, get some founder shares for putting the project together, but it has to be reasonable and explainable and defensible. Other than that, incompetence, if they're unable to raise money, completely unaware of the vultures and sharks that circle these companies, and they take money from the wrong people. In that case, you could bring in someone to help them. But I've talked before, you want to have a good combination of geological and technical skills along with capital market awareness. And you have to have both. And they have to be humble enough or aware enough to know they don't know everything. And so they're willing to surround themselves with people that can help them in that regard. So ego and hubris would be another one where, if someone thinks they know everything and they don't want to take advice from anybody and this is how I do things, then unless I really love the geology, I'm not going to get into that fight because that's just a really tough battle to fight. But I think having done thousands of management meetings, you probably can tell in the first half an hour to an hour what kind of person you're dealing with, and then dig into the MD&A and the financial statements and the historical structuring of the company. You'll learn a lot more about that, and that probably gets you 9 times out of 10 keeps you out of trouble.
Is that even the opportunity when you see a geologist running a company, but really, really focused on only geology and not raising money? And would you become activist and say like, hey, I want to support you, but I want to have somebody else joining you on this, maybe as a CEO or president, whatever, and helping you raise money, and you focus on the rocks? Would that be something you do, or?
Yeah, that's one of my favorite setups actually, Luke. Because if you get a really good geo, a lot of geos, I know a lot of them have an incredible nose for the net, and a lot of geos that end up being CEOs of companies end up doing that because they find the project, they're passionate about it, they scrape some money together, and they end up being CEO by default. But a lot of them make, I would say, like 1/10 of the money they should along the way. And I've explained this to a few geos. I'm like, look, you're really good at this. I cannot pick geological targets. I can't do grassroots prospecting. I don't know how to really find a mine at the grassroots level. You guys know how to do that. But by the way, you should be 10 or 20 times richer than you are today because you've made so many bad decisions along the way about raising money, your cap structure, financing your company properly, marketing your company, getting the right partners involved. A lot of geologists I know have made significant discovered multiple mines, but are not wildly wealthy. And why is that? Because they finance their company so poorly or made such bad decisions around the capital structure of the company along the way but the stock went from 10 cents to 20 cents instead of from 10 cents to $8. So that conversation is they're always really fun. I go, I don't do what you do. Let me help you do what I know how to do, right? Which is build value and how the market works and how to finance these companies. That's often misunderstood by geologists, but I would say, look, most of them um, are happy to have that conversation, especially when things are tough because they go, wow, it's been really hard to raise money. It's been painful. You got a great project. Let me help you. The harder ones are the finance minded people that think they know how to run a mining company or do geology or build a mine. Those ones are really dangerous because they can raise money and they raise a lot of money and then it's a train wreck, right? So
Hmm.
um, and that's harder because if they're in charge and they think they know how to do everything, it's a lot harder to make that change. So in my experience in a bear market, working with good geos that know they need help on the financing side is probably my favorite setup. Is that's probably the easiest thing to fix.
Hmm. What do you what do you do when you can't fix it? When it's not because this is I get it from your perspective, but I'm thinking about my own perspective. Like what if I notice that early on? Is my only option just get out and look for something else?
Yeah, yeah, I would say because of the size I make investments, so I'm asking that question in advance. So usually when I'm coming in, it's a most of the time it's a strategic discussion. You want me to own 10 to 20% of your company. You want me to be a 3 to 10 year shareholder in this thing.
Hmm.
Here's what I love about your project. Here's what's holding me back. You know, you need to add X, Y, Z to your team. You need to make these changes to your board. I want to refocus the company on this. Your G&A is out of control. Well, I take that down from 2.5 million a year to 750,000 a year. Are you ready to do that? Yes or no? Right? You're raising money in the wrong places. You got a big issue with a selling shareholder who got maybe 10 million shares of penny stock. You're not the guy that did it, but it's legacy holder, and he or she's been leaning on the stock. So we want to clean up that block. Help me find you buyer. So whatever issues that I have on the way in, I want to pre-package that before I make an investment. Because once I'm in, as we talked about earlier, I'm in, right? It's Hotel California. I can come, but I can't leave. So if I'm not dealing those issues in advance, I'm really putting myself in a precarious position, right? So there are a lot of opportunities. We talk about the bear market. I don't have to own 100 companies. Find the ones I like. I've walked away from a few I thought were really home run investments because I was not comfortable being able to enact the changes that I don't call myself an activist. I'm not buying a block of stock and then writing a nasty letter to the board saying, here are the things you want to do. If you want my capital, you want me to invest in your company, here's what I would like to see happen. And some say yes and some say no. But if they say no, I avoid the issue of getting involved in something where it's going to be very painful to fix or I'm now stuck with a suboptimal situation.
Hmm. Was that the deal between you and your wife when you got involved with her too?
You can ask her for an interview next week.
This is that's a podcast in and of itself, and that's probably a
She would tell
story
she would
where
tell you that she wanted to fix me, Antonio. So I learned that from her.
what is that's probably a story where everything turned out fine in the end and everyone lived happily ever after. But my gut feeling tells me that that's most often not the case in junior mining. Do you have a story for us where it didn't work out that well and you went trying to change things, but it didn't go too well? Again, feel free to name names, but if you don't want to name them, the lesson alone would be worth it, I think.
Yeah, I've had a few. I won't name names,
Sure.
but I've had a few where I would say management, advertised themselves in a way. A few situations where new management was brought in and they had the pedigree and the background to make the kind of impact that I thought they would, and they didn't deliver. And the board was too weak or didn't own enough stock or all of the above to recognize the mistake before it took too long. So I've had situations like that where maybe, when I'm the primary driver of a situation, not again, you love the bed that you make, right? So you make your own bed. I say, okay, that's the people I want in place. Sometimes I come in a situation where I'm co-investing in a deal, and it's been a partnership. Let's say if someone's coming in where you don't know them intimately well, but you're like, this is the right background, the right change, and they don't follow through on it because change is hard. You mentioned about being married, like staying married, you got to change, you got to evolve, you got to grow. Most people don't want to change, they don't want to grow, they don't want to. it's easier to do nothing than make the right decisions often. So I would say usually it's in the follow through. But usually if I'm getting to a really large, usually my 10-20% investments, if it doesn't work out, it's because the geology didn't work out or I made a mistake. The wrong person came in or, didn't push hard enough. It's mainly investments where I come in as a consortium and I've left those are ones where you're a little more disillusioned and then you don't have the energy or time or dollar investment's not big enough to kind of saber rattle and make the changes once you're already in. I would say that's probably the fairest assessment of how it goes around.
Do you typically, when it comes time to exit something like that, would you then write a nasty letter to the board and be like, you know what, I'm out, that's it, and just go out, with a bang and sell everything altogether?
No, I'm not vindictive like that. And I'm very patient. So, like I said, there haven't been too many examples like that. I said mainly it's when geology fails. When geology fails, I'm out. Um, if it's a consortium investment or investment where I've just become disillusioned and I don't feel the change is going to make, and the dollar return is not sufficient for me to really roll up my sleeves and make the changes, I'll probably exit quietly or just, I'm not going to write letters saying, I'm out, you guys suck, and I'm very disappointed in you. I don't think that does any good because in general, people are trying their best. And again, I'm not always right. So maybe the strategy was wrong, and maybe the one they pursued ends up working out. I'm not saying I'm always right. So I don't think there's any value in being nasty. I think it comes back to you if you do that. But it's a free market. If you don't like the strategy, you can vote against the board or you can sell your stock. I mean, those are two actions you can take, or you can sit there and own it. But if you really don't believe in the company and the management of the project anymore, just holding the shares probably either you're wrong or you're going to lose a lot of money, one or the other. So that would probably be not the right path to take.
Hmm.
Do you ever feel a level of fear of missing out? And I mean, you're running a serious portfolio. I'm not suggesting that you, but I think everybody has emotions, and you listen to a story. And I've seen one where the company is really early stage. They have really impressive trench results, and it's a good team. They have built good companies before, but I mean, it's a trench result, and I do think if they hit something like that below the trench, it's in a good area, it's gonna take off. But I also realize after doing this for probably 12, 13 years myself, is typically these things do not run, and it takes more time, or maybe it doesn't work at all in the future. So it's still a bet, and then my skepticism is like, shall I invest right now or shall I just wait? If they hit, I can still buy it, but then pay triple the price. I mean, of course, I'm also buying in the market. I'm not sure if you do that, but do you have a level of fear of missing out? Because that's my feeling right now. Like if I don't do it, and if they hit in this area, it's gonna take off, and I'm gonna miss it. I have considered it, and I say no, and I have to accept my decision. But that feeling of it's looking pretty good, it's in a good area, it's with a good team, that sort of feeling almost urges you to get in. Is that something that you
Yeah.
recognize, or is it something you try to stay away from?
It's a really interesting discussion. I would say, in all humility, Luke, I think one of my greatest strengths as an investor is control of my emotions. So we talked about selling at the wrong times, reacting to stock price. FOMO is real. And I'm not saying I don't have FOMO. I'll give you an example. Founders Metals, one of the best stories the last 2 years. I got offered stock, I think at 40 cents, or I forget where it was, and it was a 30 or something million market cap at the time. They just raised money at like a $5 million, $10 million market cap. It was up already a lot. Like the project, but I have a process. I'm like, okay, it's $30 million valuation. I'm gonna make 30 times that money. It's got to be like $900 million kind of market cap, assuming there's not much dilution along the way. And I was just on the fence. And because they raised money early, the stock was already up a lot. They hadn't made a discovery yet. I passed and look at my stock. I say it's on my watch list still. It's 575. I'm like, crap. But if you let yourself be consumed by FOMO, right, it gets in your headspace, and then you either make a bad investment on the next one, the next 30, $40 million market cap that comes along. You're like, oh, I don't want to miss the next founder, so I'm going to invest in that. And that goes to $2 million. You lose 98% of your money. So I really try to be disciplined, methodical, and systematic about how I make my investments and how I allocate capital. And again, what the risk reward return is going to be. And that one was the risk reward just didn't end up being one of the best discoveries. But had it not been, and I start ranking my process and start investing in every 40 million or $50 million greenfields, sexy new exploration story that comes up across my desk, I think my returns would suffer tremendously. So I have a process that's made me very wealthy. It works. It's been systematic. So by not getting emotional, not getting FOMO, or not getting overly emotional and pounding out stocks at the lows because I can't take it anymore, even though my thesis is fully intact, that's how you destroy capital. But it does mean that you're going to miss certain massive discoveries. But that's why I think, again, come back to my first point, staying systematic and regular and disciplined in your approach allows you to make better decisions consistently than chasing your emotions. Because in a good market, it'll be FOMO, and a bad market, it'll be I can't take it anymore. And neither one of those things are good for your returns over the long term.
Do you buy in the market, or are you just mainly doing financings? Because given your size, I mean, it's sort of difficult to buy, $10,000 worth of stock in some companies.
Yeah.
Are you in the market, or are you mostly doing financings and that's it?
Yeah. Mainly, I would say for my initial investment, it's for sure it'll be a financing. How I build the large percentage of my ownership positions, as you said, is you can't buy that size stock in the market without disjointing the market, right? So typically it's on a financing. You know what I do, Luke? It'll be 50 basis points to 1% of my portfolio would be my initial check size, get a good position in the company. And then if it has success, participate in each subsequent financing, either increasing my position or going in pro rata, depending on liquidity and cash I have available at the time. And then in between that, if the stock really gets disjointed, be a buyer in the market when the company is well financed and the stock is just having a bad week or a bad month. But the majority of the position that I would have would be from financing, some more exercises, just building up equity, writing checks to the company. In rare occasions, where the company is really well financed or not needing money, and I really like it, and the market's just really out of joint, I will start building a position in the market. But I'd say 80% of the time it's financing based, and that's where you can, like earlier, if you want changes to happen at the management or strategy level, that's when you have the most influence, when the company needs money and you're offering them a check versus open market buying. Obviously, they appreciate that. My commitment is I don't sell, so the company knows when I come in, I'm a cornerstone investor. We've talked in the past when you're doing a financing with a 4-month hold, if 85% of your book is selling on 4 months plus a day, you've got to do another financing 4 months later and find buyers in the market to soak up the guys that are leaving. So that's another anchor and commitment I make. I'm buying chunky positions and I'm holding them, and therefore the company knows they can build a stable register through that type of approach.
That's actually a good point, because it's one of my questions that I ask of CEOs is, how are you thinking about building your shareholder registry? Some of them don't necessarily understand why or what I'm really asking, and that already probably tells you as much as you have to know. But and again, this is you approaching it from your perspective in your portfolio. Is that how you would do it if you were running a smaller portfolio? Like, would you? I'm thinking about when the right time would be to buy something that you like. Like, would you position off the get-go, you find something you like it, you buy your full position, or would you be, getting a starter and then wait for some results and then grow or decrease your position based on the results? How would you approach it if you didn't have I suppose, the size limitations that you have right now?
Well, actually, I think it's easier to do what I do if you're smaller than if you're bigger, because you can hold a stock for 3 to 10 years if you want to adopt that kind of private equity venture capital approach like I have, or you can sell it next week if you don't like what you have. But you got to be disciplined again to sell for the right reason. So I've told many investors you need to diversify yourself in junior exploration. If you're in this space, investing in this space, and you don't own at least 20 names, I think you're asking for trouble. And so if you have $20,000 to invest, it could be $1,000 per name that you want to methodically allocate to it. And you can have the same approach that I do. You can scale up, invest in subsequent rounds on your winners. They're doing a financing. You may not have access to the financing round, but typically the day a financing gets announced, the stock goes down. So you buy it in the market that day when the financing gets announced, or you have a window of opportunity. So you do that, and you basically have the advantage of being able to be nimble if you want to reorient your portfolio without being, handcuffed or psychologically or physically handcuffed to these stocks for 3 to 10 years. So there's more advantages to be small than big, and you can have that approach. Your second question, I forget, was it portfolio sizing? I add to positions that I like. A starter position for me is 0.5 to 1% of my portfolio. And another thing you asked about capital allocation. If I get a financing, this $5 million deal, and somebody wants $1 million from me to put in the company, if I don't like the $4 million that are alongside me, I'm not doing that deal. So you asked that question, Tony. A lot of CEOs, you're right, they do not know their capital structure is bad. They don't know that they're doing a financing with shareholders that are going to be harmful to the company in the future. So if they don't know that, that's a huge red flag. They'll probably, turn me off investing in the company. And if I really like something and I know it's a $5 million book and I'm 20% of the book and the other 4 million are fast money or warrant clippers or, just not long-term shareholders, I'll either try to convince the company to find better quality money to come alongside me, or I'll pass on the deal. Because I view each financing as a partnership. Who's coming in alongside me is as important as the money they raise. I'd rather they raise less with quality than more with weekends, because that's just going to come back to haunt you, and that's going to hurt your financing and your cost of capital for your next round. You got to do after that.
Mm. What is the, I know you have to run here in a couple of minutes, Michael. So what is kind of the biggest takeaway that you've had over the last, let's call it 4 or 5 years, kind of since that summer of, what was it, 2020, when precious metals did really well and everything was running, valuations got crazy. What's kind of been your biggest takeaway from then up until now?
So one, I think it's important to remind your viewers that these stocks can run really hard, really fast when money starts flowing in the sector. And if you pull up, you're good at charts, Tony, you can pull up charts, and many stocks are up 500, 1,000, 1,500%, 5, 10, 15 times their money in a very short period of time when money flows in the sector. So we talked earlier about how do you keep your wits and how do you not lose your cool or get frustrated with the stocks. When the money starts to flow into the space, the price appreciation can be dramatic. And many of these stocks moved not on discovery, but just on valuation increases. And we're starting life at a place where it's very, 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 very low. Um, Another takeaway for investors to remember too is, when as negative as things are right now in the junior sector, the pendulum can swing to the other side. When things get really, really frothy, especially for your smaller investors on this call, don't be afraid to take some profits off the table, right? Like, don't, just because I hold for 3 to 10 years, if your stock is up 500% in 6 months, don't be afraid to take some money off the table and recycle that, or keep it for a darker time in the market when you can redeploy capital. So those would be, just two price action lessons. But yeah, this sector can really move very quickly when money starts to flow, and we don't want to forget that, because we've been through a period where these stocks have been, more bound for 3 or 4 years. It can be very, very powerful.
Well, what catalyst or snowflake could spark that shift? Is it really generalist money coming in, and what could lead to big, like, money that's not currently available in the market suddenly flowing in? Do you have any experience from previous years or
Yeah.
decades? What is causing these things?
So if you look at the last two really powerful bull markets we had in the gold market, they were both kicked off by historically the unwinding of bubbles, right? So the tech bubble, 97, 98, 99, 2000, really reminds me a lot of the AI bubble I believe we're in right now. And so all that speculative money was wrapped up in dot coms in the late 90s, and all that speculative money is wrapped up in AI and fart coin and meme coins and tokens in the crypto space. So I said this year, coming this year, all my macro factors have been lining up beautifully. I've said before, I've never seen a commodity making new all-time highs and gold making new all-time highs again today as we speak, I think. Never seen that happen and the commodities stocks be so war bound or depressed. But I have seen it happen actually in the late 90s. And you saw it happen running up in, 07, 08, before the mortgage crisis, when people didn't really pay attention to gold that much. And so what we need to see happen is we need to see the gold equities start to outperform the Nasdaq and the S&P and the stock market in general. And so far, knock on wood, year to date, GDX, GDXJ are soundly outperforming the market and the Nasdaq. That creates FOMO, which we talked about earlier. Fund managers do suffer from FOMO because they have monthly reports to give their clients, and if they are underperforming their benchmarks or their peers, they receive a lot of pressure to perform better, or investors will take money out of that fund and put it in a new fund. So I've been looking, the Monday deep seek panic we had in the market, where Nvidia is down 17%, many IEI stocks are down 30, 40%, was an amazing thing for gold investors, because it was a bit of a reality check. Those investors have been making all kinds of money without any perceived risk. They get just a one-way ride to the moon to get rich. You lose 40% a day, and if you're on leverage, you lose 90% a day. That'll shake your confidence a little bit, or shake you completely, depending on what kind of personality you have. So that's really good because that means, okay, if it's not longer easy to make money in the tech, NASDAQ or the speculative tech stocks or cryptos, some of that money starts to flow back to gold. The other thing I was saying is in an economy that's kind of sluggish right now, gold Q3, Q4, Q4 is coming out soon. Q3 was fantastic, and most companies saw massive margin expansion, EBITDA going up, earnings going up, free cash flow going up. Q4 is going to be even better, and Q1 will be even better than Q4. So on a generalist perspective, the fastest growing EBITDA or earnings or revenue growth sector in the market should be gold and precious metals. When you look at a screen of all industries, gold's going to rank the highest in terms of just fundamental, old school valuation, positive growth year over year. So you'll have screens lighting up that saying gold stocks generating the best revenue, EBITDA, profit growth in the world in terms of sectors. Relative stock performance improving. That drives fund flows. And our sector is so small. Like Nvidia lost 600 billion market cap in one day. Imagine $300 billion next week flowing into the precious metal space. Our sector is so small that money, just that's what Nvidia lost in one day. It's not their market cap, right? Just that money coming to our space, you would see massive improvements in returns across all these stocks. And they're trading at some of the lowest valuations they've traded in history and very low valuations on a free cash yield versus the market. So what we haven't had, Luke, is fund flows. And I think the stars are aligning this year, at least early on this year, to allow that fund flows to start to move towards our space. And that's what I've been waiting for. That's the last box we need to tick. I think it's happening in real time.
One concern that I have about this scenario is, I mean, what if the money really flees and the markets crash? Typically, gold stocks will join the crash. So, do you think you would need a bit of this squeeze for a while? There's a really bad month or two or three before this can happen, because I have difficulty seeing like a really bad stock market, but a really good equities gold market.
Correct. So option one, which would probably be the smoother way for us to make a lot of money in 2025, Luke, will be S&P and NASDAQ are up 2 to down 5% on the year. Sort of just become boring. The market doesn't crash, it just grinds sideways. And all these kind of meme coins and really speculative II stocks are down a lot, but the overall market's not impacted because they're small. But your crappy, I remember back in the 90s, there's companies like pets.com, eggplant.com, bozo.com, all those things went down 90%. So those things can all roll over, but the market just sort of grinds lower or just grinds sideways. But the GDXJ and GDX are up 35% because that's where the action is. That's where the best fundamentals are. That's where the most attractive valuations are. So investors go, I'm no longer making money. I'm getting bored here. I'm FOMO, gold stocks are working and my other stuff that used to make me lots of money is no longer working. That would be the best scenario where we would have a fantastic 2025, 2026, where this money starts to flow. That money increases the performance of gold equities, which attracts more investment. And that virtuous cycle we've seen in tech the last kind of 9 years starts to glow in the commodity space and the gold space in particular. The other scenario, which you talk about, is also possible. That we have a 30% correction, like we had, like kicked off the COVID rally, right? COVID market fell 30%. All the gold stocks for like 5-10 days got hammered, but they were the first out of the gate to rip. Because then that happens, you go, okay, the market's crashing, or the economy's in recession, or the AI bubble's bursting because China's figured out a way to do it 10 times faster and 10 times cheaper. There'll be a mass drawdown in the market. Yes, our stocks will go down hard for 2-3 weeks, and the market's okay. Well, that's trade is done now. Where can I allocate capital for the next 3 to 4 years and have a good backdrop? The money's, I think, going to flow to gold. And in that case, it'll be more violent on the way down, but probably even more violent on the way up because even more capital will shift to the gold space. So my advice to viewers is make sure you're not investing in gold stocks on leverage. If you take the mark, you're down for two. Like when I remember in COVID, my portfolio was down like 15%, like in over a week. And I'm like, I'm positioned for this moment. But with a month later, my portfolio was up like literally 50, and 6 weeks later it was up 100%. Right. And while the market was just clawing its way back to down 15 from down 30. So those are the two scenarios. As long as you have the fortitude to hold, you'll do really well. I'm happy to see the choppiness we're seeing in the market. I'm finally happy to see the outperformance. If we're talking in 6 months and GDXJ is up 15 and NASDAQ's down 2, I think we're going to have a rolling inflows for multiple quarters feeding this rally. So we want a rally that has legs. We don't want a rally that's going to be 3 months and done. I think the backdrop is there for a structural reallocation of capital to our sector.
I think you have to jump into your next call here, Michael. So I'll let you do your thing, but I really do appreciate your time today. Thank you so much for stopping by. I had at least 20 more jokes written down, but I'll save your ears from it. What did we forget to ask you? Any closing thoughts?
No, it's very comprehensive. I really enjoy our conversations, and save a joke for next. I'm happy to come back on again soon because I really enjoy these conversations. Very thoughtful, and hopefully your viewers enjoy it as well.
Thank you so much.
Thanks, guys.
And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really proceed him, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So please talk to a professional licensed investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things. Because if you don't do that, you are highly likely to lose your money. So, yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.